Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video I'm going to talk about 5 different companies that have absolutely amazing dividends. They are very good dividend payers. Some of them are dividend aristocrats, some of them are almost dividend aristocrat. They have a free cash flow. They are all in the same sector, so industrials. All of them are railroad companies. So I'm going to show you exactly what these companies are. I'm going to give you the details. But before we do that, I just want to ask everyone just to, if you're watching this video and you've asked me a question recently, I apologize for not getting back to you guys. His work is really busy. So inshallah, I'm going to try to answer all your questions over the weekend. Inshallah, that's the plan. But I just wanted to keep the videos going, but at the same time, inshallah, this weekend I'll sit down and basically answer all your questions as much as I can. Obviously, like I've always said to you guys, I've got a full-time job and I've got a family, so sometimes when you come home you just want to chill with your family, and it's quite hard to actually keep up with the YouTube side of things because with the family and everything that's going on. But alhamdulillah, I'm not complaining, it's great. I genuinely enjoyed doing the videos. Otherwise I wouldn't have done it. Trust me, I would not have done this if I didn't enjoy it and if I didn't enjoy the interacting with everybody else. So inshallah, I'll get back to you guys as soon as I can. But yeah, if you're watching the videos, please like the video, subscribe to the channel if you haven't already. Let me know if you have any questions, and I'll try this weekend inshallah to answer as many questions as possible. As you can see, the portfolio right now is 57,500, so it's gone down a little bit. Yesterday I've actually bought a few more stocks. Yesterday the market was absolutely crazy. I think the Dow Jones at one point I think was 1200 down. The Nasdaq was 4% down, so which is absolutely crazy. So yeah, as you can see, is right now down a little bit. Still 7% up, alhamdulillah, almost to £4,000. Remember, we were in the red at one point. So yesterday what I did was I basically added the 250 I normally add every week, and then I start looking at all the companies that I own, and I genuinely thought, you know what, to a day like this I should be able to buy a few companies. But it was very difficult because a lot of the companies I own are still up quite a bit. So maybe in the next few weeks, maybe we'll see another 5% or something like that down, and I can start buying a bit more, because I look forward to those red days. I'll be honest with you, because I'm that kind of person. I want to buy these stocks cheap while I'm still building this portfolio. I don't mind having a volatile market. It's nice to see the green. Okay, I don't like seeing this red. I think it was red at that point. As you can see, at one point we were down over £300. But on one point we were up almost, I think, £8,000 or something, and right now, as you can see, it's less than half of that. So yeah, the markets go up and down, but the most important thing is that you focus on your goals and what you want to achieve, inshallah. So yeah, today doesn't look that bad, but tomorrow might be different completely. It might be another news from the Fed, and then everything changes quickly. So yeah, just keep buying quality companies in your portfolios, and just keep dollar cost averaging every single month, and don't worry about what might happen or what might not happen in the markets generally. Right, so there's 5 companies that I said at the beginning. They're all railroad companies. So as usual, we're going to talk about the main things. So the company, the sector, the Morningstar economic moat rate. So that's basically companies that have a competitive advantage will have a wide moat and a narrow moat, and so on. Dividend yield. So 5-year dividend growth rate, payout ratio. We're looking at the years dividend increases. We're looking at the safety of that dividend, because it's important to us to know that these companies are not going to cut their dividends. We're looking at profit margins, and also we're looking at free cash flow here. Okay, total returns in the last 10 years is another thing we're going to look at. We're going to look at the growth estimates for the next basically 5 years. We're looking at the Morningstar valuations and then their fair value, and then we'll look at the Sharia compliance side of things to see if these companies have a lot of debt, if they don't have a lot of debt, and so on. Right, so the first company we're looking at is the company that I own in my portfolio. Absolutely amazing company. I love this company. Oh, by the way, before towards the end of the video, I'm going to share with you a reason why these stocks might be down quite a bit in the next few days. I'll explain in a second. Okay, so I'm expecting them to go down quite a bit, and one of them, in fact, that we're going to talk about right now, the Union Pacific, is actually down quite a bit, about 3%. So I'll explain why that is the case towards the end of the video. So as you can see, the industrials, this company has a wide moat, 2.3% dividend yield, 14 years or 14% growth, the last 5 years. Payout ratio 44%, which is a nice spot. Years increases 23 years. Now this is important. So 2 more years and this company will become a dividend aristocrat, which is really good. Dividend safety of 88%, profit margin almost 30%, free cash flow of $5.5 billion in the bank, and total return in the last 10 years we're looking at about 15.5%, which is absolutely amazing. Growth estimates, especially from a companies that are really old, so that's really great. So the last 10 years to receive about 15.5% on your money. Growth estimate in the next 5 years, we're looking at about 15% again every single year, which is really huge. Fairly valued at the moment, and $211 is the price target for this company. Again, the next company, another railroad company, CSX, and this company is also has a wide mode, 1.27% of dividend yield, which is not bad at all. 9% 5-year dividend growth rate, payout ratio 22, very nice. In terms of years increases, about 19 years, so they are also heading to that, dividend aristocrat status, if you like. Safety 85%, profit margin of 28%, free cash flow $3.3 billion, and almost 17% growth in the last 10 years. Growth estimates in the next 5 years about 14%, fairly valued at the moment, and $32 per share. Okay, again, another great company. But when you look at this, apart from the dividends, okay, everything else kind of looks more or less the same. Okay, the next one is Canadian Pacific Railroad. This company also has a wide mode. Their dividends actually less than 1%, but they have 15% 5-year growth rate, payout ratio 26%, years dividend increases about 19 years over in a row. Again, these two are very similar. Like I said, the other two, similar thing, they're heading for that dividend aristocrat, and I'm sure they're not going to cut their dividends now. They're very close to it. Okay, but the safety is what's important. Okay, some companies want to be dividend aristocrat, but they don't care about the safety of that dividends in the next few years. The payout ratio is very low, as well as the safety is actually quite high. 76% is really good. Profit margin almost at 30%. Free cash flow of $1 billion, and 17.21% total return in the last 10 years. In terms of growth, we're looking at about 9% next year, but right now this company is actually trading premium, 21% premium right now. $66 per share is where the share prices should be by the end of basically intrinsic value side of things. Okay, next company we're looking at is also another Canadian National Railroad. Again, it has a wide mode, 1.85% dividend yield, 10% of 5-year dividend growth rate, payout ratio of 48%, and 25 years of increasing. So they are now a dividend aristocrat. Obviously they are Canadian companies. I'm not sure how it works if you're trading in the US stock market, so I'm sure they will be added to that list. We'll see. 97% safety, 33% profit margin, and $4 billion in the bank right now. Total return in the last 10 years, we're looking at about 11.5% and 9% growth in the next 5 years. Again, 14% premium, $109 per share. I'll be honest with you, I'm actually interested in this company. It is quite, when you look at the numbers, actually it looks quite good, and when you look at their revenue growth as well, it actually is heading in the right directions. But that 14% might come down in the next few weeks, and I'll explain in a bit. Okay, the final company that we're looking at is Norfolk Southern Corporations, and it has a wide mode, 2% dividend yield, 12% dividend growth in the last 5 years, 37% payout ratio, 20 years of increase in that dividend, 86% safety, profit margin of almost 30%, free cash flow $2.5 billion, and total return of 14% in the last 10 years. And next 10 years, 5 years, they're expecting 11% growth every single year. Fairly valued at the moment, $246 per share is basically where the companies should be right now. So all of these companies are really great companies. They have been around for a long time. They're acquiring other companies within this company. I think is the one that acquired another business. No, it was this one. I said Canadian Pacific Railroad. Another US company recently that they can add to their portfolio. They have been around for a long time. They basically pay a nice dividend. They have old wide economic mode, which is really good. But right now some of them are trading either fairly valued or premium. For that reason, I will definitely wait. I wouldn't actually purchase this company straight away. I think Union Pacific is in my portfolio, and if you look at this, okay, my price target, if it goes below 200, actually I'm going to start adding. So today is actually down almost 4%. And the reason it's down 4% is this: there's some sort of a strike coming up soon in the rail companies. So once that starts happening, okay, this, you will see a lot of these companies going down, and they are already today. All of these companies that I'm talking about right now, the ones that are in the S&P 500, they actually quite down a little bit. Okay, it will be interesting to see what the Canadian ones are doing, but the US versions, basically the railroads in the US, are actually down quite a bit, and that strike might just be in the US, but right now it looks like there might be great opportunity for investors to look into these companies. So I just want to share that with you guys. So if you're interested in this kind of analysis and the transparency that I've been sharing with my portfolio from day one, please like the video, subscribe to the channel, and let me know if you have any questions. But before we go away, obviously we need to look at the from Sharia compliance side of things. As you can see, every single one of these companies either has 100% business activity screen wise, and then in terms of debt wise, they have quite a bit of debt, some of them, okay, 25%, okay, 26%. Remember, the cutoff according to Zoya is 30% or 33%, depending on which, basically where you look at, right? So right now I'm definitely comfortable holding Union Pacific. I don't think it's going to change quickly anytime soon. But in terms of interest-bearing securities, it's actually very low, but the debt levels, or the interest-bearing debt, that is, by the way, is quite high, apart from Canadian National Railway, sorry. So yeah, there you have it. So that is the 5 companies I want to share with you guys. Like I said, if I have not answered some of your questions recently, it's because I've been really busy. Inshallah, over the weekend I should sit down and answer some of your questions, especially brother Amir. I know you've asked quite a few questions, so inshallah I will sit down when my head is not hurting, and then inshallah I will answer your questions. Have a wonderful day. Assalamu Alaikum. Take care.